There is right now, today, approximately $17 trillion sitting in savings and checking accounts across the United States. $17 trillion. To put that in perspective, that's more than the entire GDP of China. That's enough money to buy every NFL team, every NBA team, every MLB team, and still have enough left over to buy Amazon twice. And almost all of it is earning its owners basically nothing. Not a little, not a modest amount, basically zero. And while those $17 trillion are sitting in accounts, paying their owners a rate that rounds to zero, the banks holding that money are printing profits so large, they make the word obscene feel politely insufficient. And the worst part, it's completely legal. It's not a glitch, it's not a mistake, it's the entire business model. And once I show you exactly how it works, you're going to feel like an idiot for not seeing it sooner. And then you're going to be furious. And then you're going to want to do something about it. So let's get into it. Meet Karen. Karen is 34, works in marketing, has about $22,000 sitting in her savings account at one of the 4 largest banks in the United States. She put it there because she was told that's what responsible adults do. You save money, you keep it somewhere safe. You don't blow it on meme coins. Good for Karen. Responsible Karen. Here's what Karen doesn't know. Her bank is currently paying her 0.01% interest on that $22,000. That is not a typo, 0.01%, which means Karen's $22,000 is earning her approximately $2.20 per year. Not per month, per year. You could find more than that in a parking lot. Meanwhile, that same bank is taking Karen's $22,000, along with everyone else's money, and lending it out in the form of mortgages, auto loans, personal loans, and credit cards at rates averaging anywhere between 7% and 24% depending on the product. And the difference between what they pay Karen and what they charge Karen's neighbors, that gap is called the net interest margin. And it is the engine that drives the entire banking industry's profitability. And right now, that engine is running hotter than it has in 15 years. Let me show you the numbers because they are genuinely jaw-dropping. In 2023, JP Morgan Chase reported net interest income of $89 billion. That is the money they made purely from the spread between what they paid depositors and what they charged borrowers. $89 billion in a single year from a single bank. And just to be clear on the math, JP Morgan paid out an average savings rate of roughly 0.23% to depositors during that same period, while charging mortgage holders 7%, auto loan borrowers 8%, and credit card holders upwards of 22%. That spread, that gap between what they give and what they take, is essentially a legally sanctioned wealth transfer from your pocket to their quarterly earnings report. And here's what makes it even more infuriating. This wasn't always this extreme. Let's go back to 2022. The Federal Reserve had been keeping interest rates near zero for 2 straight years during the pandemic. Banks were paying almost nothing on deposits because, frankly, they didn't need your money. Rates were zero. Borrowing was free. The whole system was flush with liquidity. Then the Fed got serious about inflation and started hiking rates aggressively. 11 rate hikes between March 2022 and July 2023. The federal funds rate went from 0.25% all the way up to 5.5%. The fastest rate hiking cycle in 4 decades. Now here's the thing about rising interest rates. When rates go up, banks can immediately charge borrowers more. Your variable rate credit card goes up within 1 billing cycle. Mortgage rates jump within days. New auto loans get repriced almost instantly. But when it comes to what banks pay depositors, that adjustment happens at the pace of a continental plate shifting, or it doesn't happen at all. And that's not an accident. That asymmetry is the whole game. The banks have essentially one speed for repricing assets upward and a completely different speed, roughly the speed of a glacier in winter, for repricing liabilities upward. And because most people don't pay attention, don't move their money, and don't ask questions, the banks just get to keep it for years. In the industry, they have a term for customers who don't move their deposits even when better rates are available. They call them sticky deposits. And if you've had money sitting in a big bank savings account for the last 3 years, earning 0.01%, while high-yield savings accounts were offering 4.5% or more, congratulations, you were sticky. And being sticky cost you. If Karen had moved her $22,000 into a high-yield savings account at the start of 2023 and earned 4.5% instead of 0.01%, she would have collected roughly $990 in interest over the following year. Instead, she earned $2.20. That's not just leaving money on the table. That's flipping the table, walking out of the room, and setting the money on fire on your way out the door. And before you say, well, it's just a savings account, it's not that much. Let's scale that up. Across $17 trillion in low-yielding deposits, economists estimate that American households collectively gave up somewhere between $400 billion and $600 billion in potential interest income during the 2022 to 2024 rate cycle alone, just from not moving their money. $400 to $600 billion handed to the banks for free because people didn't switch. If that doesn't make you feel something, I don't know what will. Now then, before I go deeper into exactly why this happens and what you can do about it, let me pause for a quick word from today's sponsor, because ironically, this is exactly where a product that actually helps you build wealth should be inserted, which brings me to sponsor placeholder, financial tool, budgeting app, or brokerage platform. Sponsor segment here, approximately 60 to 90 seconds, product details, TBD. And now back to how your bank has been legally helping itself to your money. So we've established the mechanism, the spread, the net interest margin, the beautiful, profitable, entirely legal gap between what banks pay in and what they charge out. But here's where it gets more interesting. Because the spread isn't the only tool in the kit. Banks also make money on fees. And not just the obvious ones like the $35 overdraft fee that hits you when you miscalculate by $4.23 at the grocery store. I mean the entire invisible architecture of fees that most customers have simply accepted as the cost of existing in modern financial life. Monthly maintenance fees, wire transfer fees, out-of-network ATM fees, paper statement fees, returned payment fees, foreign transaction fees, minimum balance fees if you fall below the threshold, inactivity fees, safe deposit box fees, and my personal favorite, the fee to close your account, because apparently even leaving isn't free at some institutions. In 2023, U.S. banks collected over $8 billion in overdraft and non-sufficient funds fees alone. And the people paying those fees disproportionately aren't the wealthy. They're the people living paycheck to paycheck who can least afford a $35 penalty for being $4.23 short. So you've got the interest margin, you've got the fee architecture, and then there's the third piece that nobody talks about, which is the regulatory capture that keeps the whole system running smoothly. The four largest U.S. banks, J.P. Morgan Chase, Bank of America, Wells Fargo, and Citigroup, collectively spent over $60 million on lobbying activities in 2023 alone. And what do you spend $60 million in lobbying on? You spend it making sure the rules stay favorable. You spend it making sure that proposed consumer protection regulations don't get too sharp. You spend it ensuring that the friction required to switch banks stays high enough that most customers don't bother. Because here's the dirty little secret of the banking industry. A competition, real competition, is supposed to fix this. That's the theory. If JP Morgan pays you 0.01%, you should be able to walk down the street to a bank paying 4% and move your money. And technically you can. The option exists. But the banks have spent decades building switching friction into the system. Direct deposit setups, bill pay integrations, linked external accounts, debit cards with stored payment information. Every product you stack onto your existing bank is another invisible tether, another reason to not bother switching. And it works. Research from the FDIC found that the average American has been with their primary bank for over 14 years, through rate cycles, financial crises, fee increases, and multiple periods where they were objectively leaving money on the table. 14 years of loyalty to an institution that doesn't even know your name, but definitely knows your balance. So let's actually talk about what you can do. Because this isn't a video that ends with, the system is broken and you're helpless, bye. That's not useful. First, and this is the most obvious one, check your savings account interest rate right now. Open your bank's app, find your savings account, look at the APY. If it's below 1%, you are actively donating money to your bank. High-yield savings accounts at online banks have been offering anywhere from 4% to 5.25% for the last 2 years. There's no reason a liquid emergency fund should be sitting in a big bank savings account earning 0.01%. Second, understand the fee structure on every account you hold. Go line by line. Ask your bank for a full schedule of fees. Most people have never done this and have no idea what they're agreeing to when they open an account. Third, consider the concept of banking relationship gravity. The more products you bundle with a single institution, the harder they are to leave and the less competitive pricing you'll accept. Sometimes intentional fragmentation is your friend. Checking account at one place, high yield savings at another, investment somewhere else. Annoying? Slightly. Worth it? Potentially thousands of dollars a year. Fourth, if you carry a credit card balance at 20% or more, nothing you do on the savings side of the equation will undo the math on the debt side. A 4.5% high yield savings account does not offset 22% credit card APR. Those are not in the same weight class. Fifth, and this is the one that really matters in the long run, understand that your bank's profit is not your profit. These are not aligned interests. Every dollar they earn in net interest margin is a dollar that didn't go to you. That's not cynicism. That's the business model, stated plainly. The sooner you stop treating your bank like a trusted partner and start treating it like a counterparty in a negotiation, the better you'll do. Because here's the gut punch at the end of all of this. The banking system is not broken. This is what it was designed to do. It was designed to aggregate your deposits, deploy them at higher rates, and keep the margin. And it does that incredibly efficiently. The only part that wasn't designed to work in your favor is the part where you were supposed to pay attention. And most people don't, and the banks know that. They've built a multi-$100 billion annual profit machine on the assumption that you won't check the rate, won't do the math, and won't switch. And so far, they've been right about you, about most people. So the real question isn't whether banks are taking advantage of their customers. They clearly are, legally, systematically, and at scale. The question is whether knowing this changes anything for you, whether you're going to sit there being sticky or whether you're going to stop donating your idle cash to an institution whose CEO just got a $35 million pay package while your savings account earned $2.20. I want to hear where you land on this. Drop it in the comments because I'm genuinely curious. Are you A, someone who had no idea this was happening and you're furious? B, someone who already moved to a high yield savings account and is watching everyone else figure this out? Or C, someone who knows all of this and just can't be bothered to switch because the friction is real and switching banks is genuinely annoying? There's no wrong answer. Well, there's maybe one wrong answer, but drop your take below. And if you know someone who still has their emergency funds sitting in a 0.01% big bank savings account, maybe send them this video. Because sometimes the most expensive thing in someone's financial life isn't a bad investment. It's just not paying attention.